Houses and stocks are assets. Cars and debt are liabilities. But if you follow that rule blindly in 2026, you are going to end up broke. What if I told you that your dream home could be the very thing that prevents you from ever being wealthy? And what if I told you that a $50,000 loan could be the most profitable asset you ever own? Today, we are diving into the great reversal. We're breaking down the exact moment your assets become liabilities and how to flip your liabilities into wealth-generating machines. Let us get into the math. In basic accounting, an asset is something you own. In real-world finance, an asset is only an asset if it puts money into your pocket. Take the home ownership illusion. Your primary residence is the biggest asset to liability flip. If you buy a house and the mortgage, taxes, insurance, and maintenance cost you $4,000 a month, and that house is not generating rent, that is a net drain liability. It's a liability that you hope will appreciate enough to cover the cost of living there for 30 years. Then there's the stock market stagnation. Stocks are assets, right? Not if they're illiquid when you need them. If you have $500,000 in a retirement account, but you cannot touch it without a 10% penalty and a massive tax bill, that asset is actually a liquidity liability. It's money you have on paper, but cannot use to pivot during a market crash. This is where the wealthy separate themselves from the middle class. They use arbitrage to turn liabilities into wealth. Imagine you take a loan at a 5% interest rate. Most people see that as a liability, a monthly weight. But if you use that capital to buy a business or a piece of equipment that generates a 15% return, that liability just became a spread. The formula is simple. 15% return minus 5% cost of debt equals 10% net profit. The debt is the engine. Without the liability, you wouldn't have the profit. Even a content or brand liability can flip. Buying a high-end camera or a professional studio setup is technically a depreciating liability. The second you buy it, it's worth 30% less. But if that equipment allows you to produce content that scales your reach and sells a product, it has transformed into a high-yield asset. So how do you know when the flip is happening? You look at cash flow versus appreciation. An asset becomes a liability when the cost to maintain it exceeds its utility or its growth. A vacant rental property is a liability. A stock that pays no dividend and is dropping in value while you pay management fees is a liability. On the flip side, a liability becomes an asset when the cost of carry is lower than the opportunity gain. In a high inflation environment, fixed-rate debt is actually an asset because you're paying back the bank with cheaper dollars. To survive the current economy, you need to stop collecting things and start collecting flows. First, audit your portfolio. Look at everything you own. If it doesn't send you a check every month or drastically reduce a necessary expense, ask yourself if it's actually an asset. Second, leverage wisely. Do not fear debt. Fear unproductive debt. A credit card for a vacation is a soul-crushing liability. A low-interest loan for a scalable skill or a cash-flowing business is a golden ticket. Finally, prioritize the mobility asset. In today's world, being stuck in one place is a liability. Focus on assets that are digital, portable, and global. Finance is not about what you have, it's about what your money is doing. If your assets are sitting still, they're dying. If your liabilities are working for you, you are winning. Stop looking at the balance sheet and start looking at the direction of the cash.